This 90-cent stock has fallen 50% this year, yet insiders are loading up shares. An activist investor is banging on the door, calling the valuation absurd, and Wall Street analysts think it could more than double from here. So what's going on with Bark? Is this a beaten-down dog about to have its day, or are we watching a former high flyer chase its tail straight into the ground? Bark Inc., ticker symbol BARK, is that quirky pet subscription company you might know from BarkBox. You know, the monthly box of dog toys and treats that shows up at your door. They've been around since 2011, went public through a SPAC deal in 2020, and for a while there, they were the darling of the pet industry. But here's where it gets wild. This stock is in the doghouse. We're talking down roughly 50% year-to-date, trading around 94 cents per share. And yet the people who know this company best, the CEO, the CFO, major investors, they're buying. So let's dig into what's really happening here. Bark started with a pretty great origin story. The founder, Matt Meeker, had this massive Great Dane named Hugo. He couldn't find good toys for big dogs at regular pet stores. So in 2012, he started shipping monthly Bark boxes out of a Brooklyn apartment. That WordPress site turned into a public company, now serving over 2 million dogs. The business model is actually pretty clever. They've got two main segments. First, there's the direct-to-consumer side, that's the subscription boxes, plus they've added dog dental kits and even a new dog food line. Second is commerce. Basically wholesaling their products through Target, Amazon, Chewy, Costco, PetSmart, all the big retailers. Oh, and get this, they launched something called Bark Air. It's literally chartered flights where dogs fly first class with their owners. I'm not kidding. That's how committed they are to the whole dog-obsessed brand thing. But here's the tension. The subscription side, which used to be the cash cow, has been struggling. The company intentionally cut back on marketing spend to stop burning cash. Fewer ads means fewer new subscribers. Meanwhile, the retail side is actually crushing it, up 49% year over year in the latest quarter. So you've got this interesting dynamic. Total revenue is down, but the mix is shifting. And more importantly, the company is finally getting its costs under control. Let's talk numbers, because this is where things get really interesting. Revenue for fiscal year 2024 was about $484 million. That's down slightly from the year before. Not great for a supposed growth company, right? But here's what matters. They're losing way less money. Net losses narrowed to about $33 million, down from $37 million the prior year. And in recent quarters, they've actually hit positive cash flow and adjusted EBITDA. After years of burning through cash like it was going out of style, Bark is finally approaching break-even. The latest quarter showed revenue down about 11%, but gross margins hit a record 67% on the subscription side. That's incredible for a retail business. They're focusing on higher value products, getting more from each customer, and cutting the fat everywhere else. Now, here's where the valuation gets absolutely wild. Bark has about $85 million in cash and $98 million in inventory sitting on the balance sheet. After you account for debt, their tangible net assets are around $150 million. The stock's entire market cap? $130 million. You see where this is going. The market is valuing this entire company at less than the cash and inventory it's sitting on. That's like someone offering you to sell you a car for less than the cost of the parts inside it. The stock trades at 0.3 times sales. For comparison, Chewy, their bigger competitor, trades around 1.2 times sales. That's 4 times richer. Now, Bark isn't Chewy, but this discount seems extreme for a company that's actually improving its fundamentals. Wall Street analysts have a consensus strong buy rating with price targets around $230 to $250 per share. That's more than 150% upside from current levels. Now, only a few analysts cover this tiny company, so take that with a grain of salt, but it tells you something. The pros think this is deeply undervalued. Here's where the drama really kicks in. Late October, an activist investor named Shay Capital sent a scathing letter to Bark's board. They basically said, "Are you kidding me right now?" They pointed out that the company's assets far exceed its market cap. They demanded a $25 million share buyback program to take advantage of these depressed prices. Shay also pushed Bark to leverage its inventory to free up cash and to expand into new categories like dog vitamins, supplements, DNA test kits. They've got data on over 6 million dogs. Why not monetize that? The stock jumped about 4% on that news. More importantly, it puts serious pressure on management to act. And management knows the activists have a point because insiders have been buying hand over fist. The CEO, Matt Meeker, bought 25,000 shares in June at 99 cents. He'd also bought shares at higher prices last year. The CFO bought 58,000 shares at 86 cents. Then another 55,000 at 90 cents. These aren't token purchases. These are real money bets by people who see the books every day. No insiders selling at the lows either, just buying. Insiders as a group own over 42% of the company. That's massive alignment. When the CEO and CFO are putting their own cash into the stock at these levels, that's usually a pretty good sign they believe in where this is headed. Hey, quick checkpoint on our quest for profits. If this breakdown's on point, hit like, subscribe, and ring that bell so you don't miss out on the next quest. Let's keep hunting smart plays together. All right, back to the video. But here's the thing. This isn't a slam dunk. There are real risks here. First, revenue is declining, down 5% annually over the last couple years. Subscription orders fell 18% year over year in the recent quarter. If they can't stop that slide, all the cost cutting in the world won't save them. Second, competition is brutal. Bark is going up against Chewy, Amazon, Petco, PetSmart, Mars Pet Care, Nestle Purina. These are giants with deep pockets. Bark's advantage is its brand and customer data, but if those don't hold, they could get squeezed on price and market share. Third, the cash runway. Yeah, they've got $85 million in cash and they're not burning much anymore, but if growth doesn't come back, they might need to raise capital in a year or two. That could mean dilution for shareholders, which would be ugly at these prices. Fourth, this is a discretionary purchase. Dog toys and subscription boxes are nice to have, not need to have. In a recession, or if consumers tighten their belts, Bark's products could be among the first things cut from household budgets. And fifth, the stock is trading under $1. That raises potential delisting risk if it stays there too long. They might have to do a reverse split, which often precedes more pain. So yeah, there's a lot that could go wrong. This is a high-risk situation, no question. But let's talk about what could go right, because that's the other side of this story. Bark has a few things working in its favor. They just launched a new dog food line called Bark in the Belly. That's a huge market. Dog food is massive, way bigger than toys. If they can get traction there, it could be a real growth driver. They're also expanding retail partnerships. They just added Walmart. They're growing in Costco and Target. The retail segment is already up 49%. If that continues, it could offset the subscription weakness and then some. They launched a subscriber perks program in late October to reduce churn. Basically, loyalty rewards to keep people subscribed. If it works, it improves customer lifetime value and stabilizes the base. And they promoted a new president of core business to really focus on execution. The founders are still involved, but they're bringing in operational muscle to drive results. The technical picture is interesting too. The stock hit a 52-week low around 73 cents in late summer. Since then, it's bounced about 28%. It's trading above its 20-day and 50-day moving averages now, which suggests short-term momentum is building. The 200-day moving average is still way overhead at about $1.18, so the long-term trend is still down. But if Bark can break above that level and hold it, that could signal a real trend reversal. There's also about 6 to 10% short interest, which isn't massive but could add fuel if things go right. Low float plus good news equals potential squeeze. Here's my take on all this. Bark is one of those classic high-risk, high-reward turnaround plays. The numbers are improving, the balance sheet is solid, insiders are buying, an activist is pushing for action, and the stock is trading at a valuation that assumes basically zero growth and continued mediocrity. If they can stabilize or grow revenue even slightly while maintaining these improved margins, the stock could absolutely rip. We're talking potential multi-bagger returns from here if the turnaround thesis plays out. But execution is everything. They need the dog food line to gain traction. They need retail partnerships to keep expanding. They need subscription churn to stop accelerating. And they need to do all that without burning through their cash. The next earnings report on November 10th is critical. That'll tell us if they're on track or if things are deteriorating further. Any hint of stabilization or positive guidance could spark a serious rally from these levels. I'm not saying this doubles tomorrow, but the setup is there. Deeply undervalued on multiple metrics. Insider buying, activist pressure, improving fundamentals, a market that's completely given up on the story. If you're looking at Bark, size it appropriately. This is speculative. Don't bet the farm. But for risk-tolerant investors willing to ride volatility, this is the kind of beaten-down situation where asymmetric returns can happen. It's basically a bet on whether this scrappy, dog-obsessed company can transform from a bleeding SPAC casualty into a profitable omni-channel pet brand. Can they do it? The insiders buying shares clearly think so. The activists pressuring the board think so. Wall Street analysts with price targets north of 250 think so. The market, trading at 90 cents, is saying no way. Somebody's wrong, and that's what makes it interesting. So that's Bark, a 94-cent stock with a 90% off valuation, insider conviction, and a make-or-break year ahead. The ultimate underdog story in the pet industry. Either this dog hunts or it stays in the doghouse. Pretty wild situation, right? And hey, I hope this video helps you on your quest for profits. Catch you on the next one.